Hello, everyone. Today, we will be focusing on a topic of global interest, India's upcoming 2026-27 fiscal year budget. With less than 2 weeks to go until its official release, the budget's significance extends far beyond that of an ordinary fiscal document. India's economy is at a critical juncture. On the one hand, there are external pressures in the form of global trade turbulence and rising tariff barriers. And on the other, there are internal challenges such as domestic consumption growth peaking and waning short-term growth momentum. You may be wondering, can a single budget truly determine India's economic trajectory? While it may not solve every problem, the budget is undoubtedly India's core tool for navigating its current predicament. The Trump administration's tariff measures continue to suppress Indian exports. Post-pandemic consumer enthusiasm is waning, and international oil prices remain volatile. Every policy and area of expenditure in this budget will directly impact India's ability to retain its title as the world's fastest-growing major economy, as well as its ability to break free from short-term dependencies and build a sustainable long-term growth model. Today, we will analyze India's economic situation, its challenges, and the expectations and strategic maneuvers behind this budget. Firstly, why is this budget under global scrutiny? The main reason is the complex external environment, with U.S. tariff policies representing the greatest source of uncertainty. In April 2025, the Trump administration first imposed a 25% reciprocal tariff on India, and then added an additional 25% punitive tariff due to dissatisfaction with India's imports of Russian oil. Indian exports to the U.S. now face tariffs as high as 50%. These targeted products are all key Indian export categories, including pearls, mineral fuels, machinery, electrical equipment, and automobiles, accounting for nearly half of India's total exports to the U.S. It is important to note that the U.S. is India's largest export market. In 2024, India's exports to the U.S. reached $83.6 billion, supporting the trade balance. However, after the tariffs took effect, India's exports to the U.S. plummeted dramatically, falling from $8.8 billion in May 2025 to $5.5 billion in September, a nearly 40% drop over 5 months. And the steepest short-term decline since 2019, smartphone exports plummeted by 58%, with many assembly plants seeing orders halved. Pharmaceutical exports also declined by 15.7%, eroding India's pharmacy of the world advantage. Labor-intensive sectors such as textiles and seafood fared even worse, forcing numerous small and medium-sized enterprises to lay off workers or shut down due to lost orders. While Indian exports to the U.S. rebounded by 14.5%. month-on-month to $6.3 billion in October 2025. They were still down 8.6% year-on-year, indicating the sustained impact of tariff shocks. In an attempt to alleviate the pressure, the Indian government adopted a reactive approach, which included lowering import tariffs on U.S. goods in exchange for concessions, allocating $5 billion to support businesses affected by the tariff shocks, engaging in multiple rounds of negotiations with the U.S., and agreeing to reduce daily Russian oil imports from 1.62 million barrels to approximately 1.2 million barrels. Following the October 2025 negotiations, the U.S. reduced tariffs from 50% to 35%, with both sides making concessions. Yet uncertainties in U.S.-India trade persist. Against this backdrop, the budget proposal has become a lifeline domestically. Manufacturers anticipate that lower import tariffs will reduce their costs, while the agricultural sector is calling for increased subsidies and improved procurement mechanisms. Small and medium-sized enterprises are seeking financing support and tax relief. Internationally, institutions such as the IMF and the World Bank, along with global investors, are observing how India balances external trade pressures with domestic growth, particularly with regard to policy moves in key areas such as tariff adjustments and infrastructure investment. India faces numerous constraints when drafting its budget, of course. On the one hand, fiscal deficit pressures are significant. The deficit target for FY 2025-26 is 4.4% of GDP, approximately 15.7 trillion, which leaves limited room for government borrowing. The core challenge lies in increasing investment and implementing supportive policies while controlling the deficit. The government must strike a delicate balance between prioritizing long-term strategic investments such as infrastructure and digital transformation, and addressing urgent short-term needs. In early January 2026, India's Commerce and Industry Minister, Piyush Goyal, explicitly stated that the new budget would focus on stabilizing growth, enhancing competitiveness, and attracting investment, introducing targeted measures to counter external challenges. This statement further heightened market expectations. In reality, the budget's influence extends far beyond fiscal matters, directly determining whether India can maintain its position as a leader in growth and transition from short-term recovery to long-term, high-quality growth. Against the backdrop of a global economic slowdown and rising trade protectionism, India's performance is being watched closely worldwide. Having set the scene, let's take a look at India's current economic performance. In its November 2025 country report, the IMF raised its GDP growth forecast for FY 2025-2026 to 6.6%, while projecting a slowdown to 6.2% for FY 2026-2027. Despite this deceleration, India remains the fastest-growing major economy globally, particularly given the world's projected growth rate of just 3.3%. The IMF's upward revision acknowledges India's current performance, while the projected slowdown reflects near-term growth pressures. This quarterly rebound was primarily driven by agricultural and industrial recovery, as well as rural demand. Construction grew by 8.6% year-on-year, benefiting from infrastructure investment, while financial and real estate services expanded by 7.2%. Trade, wholesale, and retail services increased by 6.4%. While agriculture, forestry, and fisheries grew by 3.1%. Mining was the only sector to record negative growth, at 0.8%, due to commodity price volatility. India's economy started strongly in FY 2025-2026, with Q1 GDP growing 7.8% year-on-year and exceeding market expectations of 7.2%. This was largely driven by the goods and services tax (GST) reform implemented in September 2025. This reform simplified the tax structure, reducing rates for certain consumer goods and production materials by 3 to 5 percentage points. This directly stimulated consumption, lowered corporate costs, and offset the negative effects of U.S. tariffs, establishing itself as a pivotal policy in bolstering economic resilience. Multiple high-frequency indicators also confirm economic vitality. India's average food inflation rate in 2025 stood at just 2.1%, demonstrating effective inflation control. This allowed the central bank to implement an accommodative monetary policy, resulting into benchmark rate cuts totaling 50 basis points throughout the year and reducing corporate financing costs. The financial sector's resilience was strengthened as bank credit grew by 11.2% year-on-year, with the infrastructure and manufacturing sectors receiving priority support. Service exports were a standout performer, reaching $38.52 billion in October 2025, a 15% year-on-year increase. The annual surplus is projected to exceed $45 billion, setting a new record. with information technology, business services, and tourism forming the core pillars of this growth. Furthermore, India's manufacturing PMI consistently remained above the boom-bust line throughout 2025, averaging 54.3. This indicates stable production and orders, as well as rising business confidence. Government infrastructure investment continues to drive growth, with capital expenditure rising by 13.4% year-on-year in the first half of 2025 and boosting upstream industries such as cement and steel. However, the IMF cautions that growth is expected to slow in FY 2026-2027, primarily due to fading short-term momentum and a complex external environment. To achieve sustained long-term growth, India must implement structural reforms rather than relying solely on short-term stimulus. You might now be wondering, what short-term factors fueled India's post-pandemic recovery? Two factors primarily: the concentrated release of pent-up domestic demand and the sharp global oil price decline in 2025. These forces work together to propel India's economy out of the shadow of the pandemic, achieving 6.5% growth in FY 2024-2025. First, consider the concentrated release of domestic demand. Strict lockdowns during the pandemic suppressed consumption and investment, leading to pent-up demand that surged when restrictions were lifted, becoming the core engine of recovery. Since 2021, Indian household consumption expenditure has grown by an average of over 7% annually, accelerating further after the 2025 GST reforms. This expansion covers both essential and non-essential goods, indicating a broad-based recovery. Essential goods consumption saw food retail sales grow by 6.2% year-on-year in the first half of 2025, while apparel sales increased by 7.8%. Consumption of staple foods remained stable, with faster growth in nutritious items such as vegetables and fruit, reflecting an improvement in the structure of consumption. Non-essential consumption showed even more pronounced growth. From January to October 2025, passenger vehicle sales reached 3.87 million units, marking a 14.3% year-on-year increase, while sales of new energy vehicles surged by 45.2%. Meanwhile, smartphone sales reached 152 million units, marking an 8.9% year-on-year increase, with mid to high-end models accounting for 32% of the market. Home appliance sales grew steadily too, with rural markets emerging as a significant source of incremental demand. Consumption in the service sector also showed a robust recovery. In Q3 of 2025, tourism revenue increased by 23.5% year-on-year, with domestic tourism rising by 28.7%, and international tourist arrivals recovering to over 85% of pre-pandemic levels. Restaurant revenue increased by 18.2%, with takeaway orders surging by 21.5%. Box office revenue grew by 31.4%, with multiple domestic films exceeding 1 billion rupees in revenue, indicating the rapid release of cultural and entertainment demand. This recovery in domestic demand stems primarily from two factors. First, the gradual release of household savings accumulated during the pandemic. Data from the Reserve Bank of India shows that the household savings rate increased from 30.1% in 2019 to 34.5% in 2021, adding 2.3 trillion rupees in savings. These savings were converted into consumption once lockdowns ended, although the savings rate had fallen back to around 31% by 2025, suggesting that the benefits of increased savings are gradually fading. Secondly, government stimulus policies came into effect, with 3.2 trillion rupees in cash subsidies being distributed to low-income groups, covering 400 million people. Support for small and medium-sized enterprises and tax rate reductions also stabilized employment and consumption capacity. Now consider the second short-term driver, the significant drop in global oil prices in 2025. India relies on imports for 85% of its crude oil, making it highly vulnerable to fluctuations in international oil prices, which directly impact import expenditure, trade deficits, and inflation. In 2025, imbalances in the supply and demand for energy caused Brent crude to fall 18% and Dayak crude to drop 20% over the year. Year-end closing prices reached $61.30 BBL and $57.46 BBL respectively, marking the largest annual decline since 2020. While India's crude oil imports increased slightly year-on-year in 2025 with total imports from April to October, reaching 142.687 million tons, an increase of 1.5%. The decline in oil prices reduced the total import value by $31 billion, a 19.5% decrease. The trade deficit narrowed from $268 billion in 2024 to $232 billion, a reduction of 13.4%, alleviating pressure on the rupee's depreciation. India is also optimizing its import structure, with the Middle East remaining the primary source with a 44.8% share and Russian imports accounting for over 20%. This diversification strategy mitigates supply risks. The decline in oil prices also lowered costs across multiple industries through supply chain effects. Aviation fuel costs fell by 22.3%, improving profitability and boosting passenger traffic by 16.7% year-on-year. Chemical industry raw material costs dropped by 18.5%, increasing profit margins by 3.2 percentage points. Transportation sector operating costs decreased by 10.2%, enhancing the efficiency of commodity circulation. Simultaneously, lower oil prices eased inflationary pressures. The IMF projects that India's inflation rate will decline to 2.8% in FY 2025-2026, which falls within the central bank's target range of 2 to 6%, creating room for monetary policy easing. However, it must be emphasized that neither of these two short-term drivers is sustainable in the long term, and their effectiveness is gradually waning. This is the core reason behind the IMF's projection that growth will slow to 6.2% in FY 2026-2027. Turning to domestic demand, key consumption indicators have decelerated since Q4 2025 as the savings dividend fades. Passenger vehicle sales grew by 8.3%, a decline of 6.3 percentage points, and smartphone sales increased by just 5.1%. The lack of fundamental improvement in the employment situation also constrains consumption. In October 2025, India's overall unemployment rate was 7.1%, which is 1.3 percentage points higher than pre-pandemic levels. Youth unemployment reached an alarming 23.5%. Many young people lack a stable income, which limits their consumption capacity. Additionally, rising household debt levels, reaching 37.2% of GDP in Q3 2025, up 5.1 percentage points from 2021, have increased repayment pressures and dampened consumer confidence. The Reserve Bank of India has warned that the foundation for consumption recovery remains fragile. Regarding international oil price uncertainty, the low oil prices seen in 2025 are unlikely to persist into 2026. Authoritative institutions predict that oil prices will follow a low to stable trajectory in 2026, potentially rebounding by 10 to 15% after hitting a mid-year low. Three primary factors will drive this rebound. First, OPEC will suspend production increases in Q1 2026, which will slow supply growth. Second, global crude demand will gradually rise, with demand for chemical feedstock leading the way. Third, geopolitical tensions in the Middle East and US-Iran confrontations may trigger supply disruptions. A rebound in oil prices would negatively impact India's economy in multiple ways. Increased import expenditure would widen the trade deficit and put pressure on the rupee exchange rate. Inflation would rise, potentially approaching the central bank's 6% target ceiling. This would constrain monetary policy easing and could even force rate hikes. This would increase corporate financing costs and suppress investment and consumption. Historical precedent confirms that sharp oil price surges in 2018 and 2022 previously hindered India's economic growth. India must therefore swiftly break its dependence on low oil prices and build a more resilient energy supply and growth model. Facing waning short-term momentum and slowing growth pressures, India must cultivate new growth drivers to sustain long-term expansion above 6%. The Indian business community has submitted a wish list to the government centered on two core demands: sustained increases in capital expenditure and optimization of import tariffs for manufacturing. These demands closely align with the government's long-term strategy. With regard to the call for increased capital expenditure, the Confederation of Indian Industry (CII) has led a proposal for a 150 trillion National Infrastructure Pipeline 2.0 due to be implemented by January 2026. This initiative focuses on rapidly deployable, revenue-generating infrastructure projects, streamlining approvals and attracting private and foreign investment. The emphasis on infrastructure stems from its dual role. It stimulates investment and reduces logistics costs, enhances efficiency and creates jobs, making it a core driver of long-term growth. Over the past decade, India has made significant progress. The length of national highways has increased from 91,000 to 146,000 kilometers. The length of electrified railway lines has exceeded 45,000 kilometers. 780,000 kilometers of rural roads have been completed, and 88 airports have become operational. However, significant challenges remain. Logistics costs account for 14% of GDP, far exceeding the 8% to 10% range observed in developed nations. Furthermore, 25,000 rural settlements remain unconnected by roads. And power shortages and uneven water distribution in certain regions continue to constrain economic development. Beyond traditional infrastructure, the business community is calling for increased investment in digital public systems and future technologies. Proposals include establishing a 10 billion rupee digital fund to accelerate digital transformation in the regulatory, tax and customs sectors, and creating an India Development and Strategy Fund to mobilize capital for SMEs and the energy transition. Increasing R&D investment to support emerging fields such as artificial intelligence and clean energy is closely aligned with the Indian government's research, development and innovation plan, launched in 2025 with the aim of raising R&D expenditure to 2% of GDP by 2030, allocating 1 trillion rupees. Regarding the call to optimize import tariff structures for manufacturing, India's high reliance on imported core components and raw materials, coupled with elevated tariffs, hampers industrial upgrading and competitiveness. In the electronic sector, for instance, the demand gap exceeds $100 billion. With an 81% dependency rate on imported core components and 100% reliance on imported aerospace-grade components. Previously, high tariffs made local manufacturing costs 16% higher than in Vietnam. However, by 2025, India had implemented multiple rounds of tariff adjustments, reducing tariffs on core components for mobile phones and televisions to zero, and cutting those on aerospace-grade electronic components from 24% to 12%. This had a significant policy impact. By December 2025, electronic component imports had surged by 45% year-on-year. Domestic enterprises had seen a 22% increase in capacity utilization, and exports to Southeast Asia had grown by 35%. Building on this success, the business community is now calling for further tariff optimization. The Confederation of Indian Industry (CII) is proposing the implementation of a three-tier tariff structure: zero or minimal tariffs on raw materials, 2.5 to 5% tariffs on intermediate products, and standard rates on finished goods, thereby aligning with global manufacturing hubs. Specifically, they propose reducing tariffs on camera modules and flexible printed circuits for electronics manufacturing, reducing tariffs on raw materials such as rutile and coking coal for basic industries, and lowering tariffs on core components for new energy vehicles in automotive manufacturing. Businesses are also calling for the establishment of a tariff dispute resolution mechanism and the streamlining of customs clearance procedures to reduce legal and time costs while enhancing operational efficiency. Sectors including automotive and chemicals have echoed these demands, seeking to boost product competitiveness through tariff reductions. Globally, the IMF projects 3.3% economic growth in 2026, driven by surging high-tech investment and trade diversification. The U.S. investment boom in AI and clean energy is driving global expansion. In order to achieve sustained long-term growth, India must align with this trend by balancing resilience against external shocks with growth momentum. This requires cultivating endogenous drivers while mitigating risks through diversification. Global technology spending reached $4.9 trillion in 2025, marking a 5.6% year-on-year increase. With artificial intelligence emerging as the primary growth driver, global AI financing totaled $226 billion, accounting for 48% of total venture capital investments. By contrast, India's high-tech industry contributes just 8.3% to GDP, with R&D expenditure below 1%, highlighting a significant shortfall. To achieve high-quality growth, India must increase investment in high-tech sectors. To counter external shocks, India's core strategy is to advance trade diversification in order to reduce its reliance on the U.S. market. Significant progress has been made, most notably with the signing of the Trade and Economic Cooperation Agreement with the European Free Trade Association (EFTA). Upon its implementation in October 2025, EFTA will commit to investing $100 billion and creating 1 million jobs over 15 years, which will substantially expand India's access to European markets. India also signed a free trade agreement with the UK in July 2025, and negotiations for FTAs with the EU and Australia are entering critical phases. Meanwhile, bilateral trade with ASEAN grew by 12.3% year-on-year, while trade with China increased by 10.2% to reach $89 billion, gradually forming a more diversified trade pattern. Simultaneously, India has diversified its foreign exchange reserves by reducing its holdings of U.S. Treasury bonds and increasing its gold and euro-denominated assets. By the end of 2025, foreign reserves had reached $696.61 billion, with gold reserves accounting for 9.2% of the total and stabilizing the rupee exchange rate. In 2025, exchange rate fluctuations remained within 2.3%. Nevertheless, India continues to face challenges in balancing growth and resilience. Firstly, fiscal space is limited due to significant deficit pressures, mounting government debt and rising borrowing costs, which constrain investment capacity. The IMF has urged India to strictly enforce fiscal discipline and enhance spending efficiency. Secondly, structural domestic issues remain significant. Labor force participation stands at just 47.3%, with youth participation below 30%. workforce quality is low and skills training is inadequate. The business environment lags behind that of Southeast Asian nations and is plagued by cumbersome approvals and corruption. Small and medium-sized enterprises (SMEs) face a financing gap of 2.5 trillion, with over 60% struggling with costly and difficult access to capital, which hinders enterprise development. Additionally, the risks posed by climate change cannot be ignored. Agriculture contributes 15% to India's GDP and over 60% of the population is dependent on it. However, the sector is weak in terms of resilience to disasters. Frequent extreme weather events in recent years have led to reduced crop yields and agricultural price volatility, impacting farmers' incomes and inflation stability. The drought in 2025 caused a decline in grain production of between 3% and 5%, adding pressure to inflation control. Overall, India's economy is currently maintaining steady momentum, supported by ample foreign reserves, an optimized industrial structure, and breakthroughs in trade diversification. However, short-term growth drivers are waning amid concurrent internal and external challenges. The upcoming FY 2026-27 budget is a pivotal moment for India's economic transformation, as the direction of its policies will directly determine the nation's ability to cultivate long-term growth momentum. To achieve this, India must deepen structural reforms by improving the business environment and addressing employment and SME financing challenges. Increase investment in infrastructure and high-tech sectors while enhancing innovation ecosystems. Advance trade diversification and optimize tariff structures. Strengthen climate change responses and ensure food security. Strictly enforce fiscal discipline to optimize expenditure allocation. Only by taking these measures can India sustain robust growth amid complex global dynamics, maintain its position as a major economy with high growth rates, and contribute more significantly to global economic expansion. India's economic trajectory indeed mirrors the shared challenges faced by emerging economies in the global landscape, balancing short-term growth with long-term transformation and shielding against external shocks while cultivating endogenous momentum. The outcomes of implementing this budget will determine India's economic direction in the coming years and provide a reference model for other emerging economies. We will continue to monitor whether India can leverage this budget to overcome current challenges and embark on a new chapter of economic growth. That concludes today's coverage. We hope you now have a clearer understanding of India's economic landscape, the challenges it faces, and the importance of this budget. We will continue to track economic developments across major global economies, providing more comprehensive and in-depth analysis. Thank you for listening.